Today we just want to do, today we are doing advanced capital budgeting decisions. This is just an extension of a topic we did on our intermediate level. I remember we did capital budgeting decisions. And I remember during those days, we used to say that these refer to the investment decisions of a firm, right? The organizations that we are operating today, they normally make some decisions which might be positive or negatively, depending on how they are going to be implementing the decisions. And that is where we are saying the decision on how the firm should invest in long-term projects so as to maximize the shareholders' wealth. And that is what we normally call the value of the firm. And we know very well today, when I look on you guys, we have families, and sometimes we normally want to invest to keep that family safe in the future in case of any risk which might be involved. And in this case, the reason as to why we normally invest is because we want to maximize some wealth. And you may find that, for example, Lillian, investing on money market funds, someone else will be having a different decision. He says, can I be able to invest on bonds? So I will be able to open the CDs account with the Central Bank of Kenya. The other people will say no. Whatever I normally do, I like to invest with circles, right? The other people will say no, because I normally deal with assets. Can I be able to invest with NCBA, right? The decisions are always different depending on how all the goals in which everyone want to achieve. And that is where we are saying, when it comes to the organizations, what are these decisions are we talking about? One, we normally look on the expansion of an existing project. Number two, we look on the replacement of the replacement decisions. Number three, we normally talk about the undertaking a new project. That is the product line. Then number four, we have to be looking on the research and development activities. But we normally have some challenges which these organizations might be facing. What are the challenges? One of the key challenges here, we are saying that there must be a certainty, right, in the expected economic life of the project. Some of us, we normally say, I want to invest on a given financial institutions, and that is the area where I feel comfortable placing my finances there. For example, some people will be able, and I remember I was able to discuss with some of you regarding to the investment of these people who are young, who are calling you dad and mom. These people, for instance, you have already checked on, can I be able to come up with a junior account? And the junior account, you say, can I be able to put 3,000 to 4,000 in case in the future we can be able to support his or her education? And that is where we are looking at. Can you be able to predict the certainty of the project which you're undertaking? That is one thing in which the businesses have to be taking, and therefore the risk must be involved. That is why we are saying there must be uncertainty. Those are the challenges which you might be facing when you're implementing some economic life projects. Number two, we are talking about uncertainty in the expected future cash flows, which are always based on the forecasted values. I will be able to give you a direct example with the KQ. I have dealt with some investors of the KQ there before, and these people invested during that period. For example, someone bought some shares there with a maturity period of 15 or 20 years. And when you look on it, during that time, KQ might be performing well during that period. But what about today? When you look on the cash books, not the cash book, but when you look on the books of that organization, we are going to be knowing that the cash inflows might not be certain as how you predicted in the past. Number three, we are talking about inadequate information. And that is where we normally make the wrong decisions based on which circle can we be able to invest? Where can I be able to invest to purchase the fixed assets? Where can I be able to invest to accumulate some wealth? Those are the things that we have. Some people will be able to tell you, can you be able to invest with ICA Lions? Other people will be able to tell you, can you be able to invest in NIC? Other people will be able to tell you, can you be able to take the package for MMF? For Cyton. These are information If you are not well directed, you might be getting the wrong information. But another one we have uncertainty in the cost of capital, and that is where we are looking on. The firm's WACC is subject to some fundamental assumptions which they may affect the projects. And the reason as to why I've taken this topic is because it's going to be assisting us to understand more. The advanced financial decision is as stated last period when we met. I said we are going to be doing the advanced financial decisions, but I have choose first we do the capital the capital budgetary decisions, because this is something that is going to be connecting you, and also this topic is not as wide as the advanced financial decision. So I saw it is very good we finish up with this one, and then we'll be able to get back to the other topic. Now, what are some of these types of investment projects? Number one, we normally talk about the mutually exclusive projects. And these alternative projects which always compete with one another and cannot be undertaken together. And the selection of one of the mutually exclusive projects automatically disqualifies the other projects. So it means, for instance, this is what normally happens with the selection of the people who we are calling now husband and wives. You normally have some varieties which you normally say, can I be able to choose in a group of 4 or 5, or the number that you have based on your criteria for selection. And then we normally say, I just need only one wife, or I need one husband. So in this case, when you are choosing, you normally take some time. That is why during those days, you used to hear some ladies say, I need some time to think. So in this time, they have agree, it just takes some time to evaluate the choices he or she has. That is one. So once you choose one, then automatically disqualifies the others to become your husband or wife. Number two, we talk about the independent projects, and we say these are not related in any way, hence they cannot be undertaken subject to their profitability and availability of cash. So in this case, we have to be looking on how can we be able to undertake the projects. Independent projects, it means they are not depending on each other. And in this case, each project can be undertaken if the organization is having enough cash flow to do so. The other one, we are talking about the complementary, and this one we talk about the dependent projects, and we are saying these are the projects which rely on each other for survival, and they must be undertaken together. That is, the selection of one of the complementary projects automatically leads to the selection of the others, e.g., where the finished goods of the projects become the raw materials for another project. I remember there is a time you did management accounting, whether at undergraduates, posts, or you did it in you did it somewhere. But in this case, you normally find that when you are dealing with the complementary projects, it normally reminds me of a topic we used to do called process costing, whereby the output of one process basically became an input of the next process. For example, if a product normally takes more processes, the same applies here. If, for example, when you look on the output of project A becomes an input of project B, then automatically you cannot forego one. You have to undertake all of them. But there is one thing that you're going to be learning as we move forward, and this one basically needs you to understand what is a divisible and indivisible projects. You will find that divisible projects are projects that can be scaled downwards, hence implemented partially. When you talk about partially, it means, let me, for example, look on the, and we'll be able to check on it when you are doing the capital rationing here, whereby the questions of partially implementing and the fully implementation in regards to divisible and divisible projects normally arises. So when you discuss about the divisible projects, it means once you rank your projects using the profitability index, PI. I know that word, you had it before. When you are ranking your project using the PI, you're going to be identifying the best projects and the worst projects. And in this case, it means you are going to be putting enough resources on the best projects which are going to be giving you the highest returns. And then you will be able to scale down based on your ranking by looking on the capital that you have, and you say, based on the capital that I have, I can be able to implement project A fully. Project B, I can be able to finance it fully, but I cannot be able to finance project C fully. What I can be able to afford is the remaining amount. For example, let me talk about 70,000. you will be able to invest 70,000 partially of a project which required you an initial outlay of, let me talk about 120,000. That is what we normally talk about divisible and divisible projects. But mostly it is applicable in capital rationing. It is mostly applicable there. Now, let me look on the importance. And these notes I said you have to be passing through them. We are saying that the investment decision must be carefully planned and made for the following reasons. Those are the benefits. One, they involve significant amount of cash flow, hence can lead to heavy losses in case of failure. Number two, such decisions are highly irreversible or can only be reversed as substantial losses. Number three, we are saying the decisions affect all the departments of the company, which may influence the operations of the entire firm negatively in case of failure. The other one we are talking about, it may affect the morale of all employees of the firm in case of failure due to the inputs made by each one of them in the initial implementation stage. But when you look on the last one, we are saying it may be able to affect the overall risk of the firm due to high cash outflows involved in its implementation in case of failure. Those are some of the things that you have to be checking on. You can just be able to come up with your more benefits based on how you have understood. I will not be able to pass through the characteristics of a good investment appraisal technique. These things are already there with you, but allow me just to check on one of the crucial areas. And these areas, I will be able to focus on them based on how they are being asked by the examiner. And in this area, we are looking on the investment appraisal techniques. And we are saying here, not non-discounted cash flow techniques, the investment appraisal techniques is normally grouped into two. One, and I remember one, we are discussing about non-discounted cash flow techniques. Basically, there before we used to call them traditional techniques, which are normally grouped, subdivided into two. One, we talk about the accounting rate of return. Number two, we discuss about the payback period. Number two, classification of the investment appraisal techniques, and these are the things that I know very well, are familiar with you. Basically, there before we used to talk about the modern techniques. We have the net present value, we have the internal rate of return, profitability index. So the second last, we have the discounted payback period, and then we have the modified internal rate of return. I will be able to tell you for a fact. Allow me just to do the payback period, net present value, internal rate of return, and then the profitability index, right? The others, I will be able to ignore them. Now, when you look on one of the crucial things in which the examiner is bringing here, when you look on the exams which you have already done, and I know you have done these exams for those who are doing the receipts, it is very crucial to understand that most of the areas which have been tested from these investment appraisal techniques is the NPV. And I want just to be able to show you, how do you normally make the decisions using the NPV? What are some of the steps which you normally follow in the computation of the NPV? And what can I do when the examiner is silent? Sometimes you are being given a question, but the examiner does not tell you whether you are supposed to be calculating the NPV or not. And I will be able to advise you very clearly that when the examiner is silent, always learn to use the NPV. Now, when it comes to the accounting rate of return, it is not tested here. Basically, under the intermediate level, it is tested. But it is good to know it is part of the traditional techniques. What is most important is the payback period. And it is very crucial to understand a payback period is a period which we normally undertake to recover our initial outlay. For example, we have invested 1 million. The company which we have invested, or the company yenye tumefungua with Brevin, or Bravo, it is generating 500,000 per year. Sometimes we normally discuss about regular cash flows. A regular cash flow is the cash flow which looks similar throughout. For example, January ikatupea 1,500, February 500,000, March 500,000. Throughout to December, a business was able to give you a cash flow of 500,000. That is what we normally discuss about regular cash flows. And how do I normally get the payback period? When I'm using the regular cash flows, I will be able to tell you for a fact. When you're using a regular cash flow, we normally take what? We normally take our initial outlay. This is the cost of capital or the investment which you have made, the investment costs We normally take our initial outlay, then we normally divide it with the annual net cash flows to determine how many years can I take when I'm generating 500,000 per month to get back my 1 million, to get back my 1 million. That is one step for the payback period under the regular cash flows. But when we are using the irregular cash flow, and these are the things that you need to be now understanding very well, because there previously we used to discuss about things like a lump sum and annuity. These are the things that you have learned under the time value for money topic under the intermediate. So when we are talking about a regular, it means it is similar to the annuity criteria that we used to do under the section 3, because the annuity, it means we are going to be getting similar, and that is what we talk about, the annuities. And you know that we had a different formulas for annuity. And now, when you talk about a lump sum, and here we are discussing it as irregular cash flows, you'll be able to find that under the irregular cash flows, the cash flows are not similar. For example, year 1, the business might be giving you 150,000. Year 2, the business might be giving 157,000. Year 3, the business might be generating a cash flow of 159,000. You can see those cash flows are not the same, right? The biggest question is, how do I normally calculate my payback period when we are using irregular cash flows? And be able just to tell you for a fact, when you're using that, you normally do what? You normally accumulate your cash flows until you attain your initial outlay. For example, you remember how we used to do the decision theory under QA? You used to have the years, then we have our cash flows, then you accumulate there before. So in this case, when you're accumulating the cash flows, we just want to add the cash flows which we are generating until we attain 1 million, for example, 1 million, right? So under this addition that we are doing, it is very critical to understand these additions which we are doing, they might be, we might find a certain year where we don't require the full amount. For example, tumeadd year 1, tukapata 450,000, year 2, tukapata 650, year 3, inagenerate, for example, 700,000, but ukiadi pale kwa 650, itakuletea 13 something, right? But wewe uhitaji hiyo yote, wewe unahitaji ile inakukuitia 1 million. So you'll just say, a difference yenye inanipea ni 350. So to determine the period which the business can be able to generate 350 during the year, you just take the 350, you divide by the cash flow generated during that year to get those points. I'll just be able to show you when you are doing our illustrations. So in that case, I know now, nimesharuka hizi vitu zote. So where we are, tuko hapa hivi. We were here. And here we are saying for a project generating irregular annual cash flows, we accumulate the cash flows until the total is equal to the initial. I will be able to show you that. But how do I normally accept the project under a payback period? We say the management will be able to establish the maximum acceptable payback period expected from the project. So unajua vizuri sana, even Hamed knows this, that the project that has a minimum period for the recovery of the initial outlay is the best. For example, hakuna mtu hapa anataka anikopeshe pesa ama nimkopeshe alafu I take 4 years to pay me. Lakini ule mtu unakopesha leo anakurudishia kesho, right? Huyo ndo unasemanga, every time this guy is going to be asking money, nitakuwa nampea. You see that? Because he's able to refund based on the agreeable period. But the people under the projects which will take longer to give you the initial outlay, those are the bad projects. Now, that is the acceptance. So we are saying the project whose PBP is less than the time which is set by the management is accepted, while the project with the PBP higher than the time set by the management are rejected. So the lower the PBP, as I have said earlier, the better the project. The advantages and disadvantages, I have put them there. But what I am fully much engaged is to know how to do the NPV questions. So under the discounted cash flow techniques, we are saying, this technique consider the time value of money. We are supposed to be talking for money by discounting the cash flows. They include, when you discuss about the discounting, we normally have, for example, nimepromise. Let me talk about Catherine. Catherine nimemwambia, in 2027, I will give you 1 million. Right? So, leo Catherine anajiuliza, na leo itakuwa pesa ngapi? Leo hii pesa unaniambia 2027 itakuwa 1 million. What is the value of that money today? And that is what we normally discuss about the discounting of the cash flows. You have the future value. You want to determine the present. So that is where we are discounting to get the present values. They normally include, those are the criteria mulisoma huko chini. So here we have the net present values. And when we discuss about the net present values, we normally look on the cash inflow. Ile pesa unapata saizi kama income, Jackie. Ile pesa unapata kama income. Na ile pesa already unatumia. The difference is what we are discussing about the NPV. And that is where we normally say, under the acceptance criteria here, the NPV which is positive, you have to be accepting that project. The NPV which is negative, you have to be rejecting that project. And the NPV which is equal to 0, that project might be accepted. The decision will be live with the management, whether they are going to be taking the risk or not. So the cash flows are discounted using the firm's cost of capital. I remember very well when you are doing the section 3, and that is where I just want to pass through there, is because under section 3, we were able to do the cost of capital. And we discussed about around 2, right? We discussed about the WACC, and we discussed about the WMCC. One, when we discussed about the WACC, we used to talk about looking at the existing capital structure of the organization. Each organization we are dealing with, eco-financed with what? What is financing this organization? And in this case, you normally find the organization might be or might vary depending on the sources of funds. Some of the organization may tend to choose to be financed by equity and debt. Others will be able to choose to have equity, which is the ordinary shares and retained earnings together with the reserves and so on. Then we have things like preference shares and debts or debentures. So in this case, the WACC basically checks on the existing capital structures, the existing capital structure of the organization, right? And we look what is the value of the firm. Those are the critical things. Now, when we discuss about the WMCC, because these are the things that we shall be able to look on them later, under the WMCC, we normally look at, tuko na project mpya we want to undertake. We want to kulima nyanya, for instance. We want to plant tomatoes or potatoes, whatever you want to plant. And in this case, we are already on a middle point over here. For example, mwaka ya kampuni isha songa. For example, 4 to 5 months. The money that we allocated are basically intact. We don't want to interfere with them. Then the biggest question will be, how am I going to be utilizing? Where can I be able to get extra funds to finance my already existing or my new project? And we'll be able to say, can we be able to look on the existing capital structure of the organization? Where can we be able to maximize fully, right? To get the extra amount we require. And that is where we normally discuss about looking for new funds from the existing, without interfering with the organization. Utakuja upate organization mwenyao. Utakuja upate organization is being financed by equity and debt. Woseme this existing capital structure is not okay. Can this organization be financed by preference share? No, we cannot be able to do. Kama hii organization tumeambiwa inafinanziwa na equity na debt, huko ndio tutatafuta pesa. By using something called breakpoint, you will be able to enjoy so much when you are doing the advanced financial decisions. Allow me just to show you a format for the computation of the NPV, which is very crucial. And we are repeating a job that we have already done, right? These are the things you did. I know that. So when you look on the what are we looking for? When we are looking on the formats for this computation, you'll be able to find things that we did there before and are not hard to get. So in this case, we are saying, because here we are doing what? A very interesting topic called advanced capital budgeting. Capital budgeting decisions, very interesting. So this is very interesting topic. Very interesting topic. And in this case, I just want us to look at, number one, we have discussed about NPV. And we just want to know, how can I be able to compute the NPV? how can I be able to compute the NPV? I know that the network will be able to stabilize and the camera will be able to show you very well. So when you're looking on the NPV, we have said, this is the difference between, it is the difference between the cash inflows and cash outflows and the cash outflows. And I will be able to check on how can this happen? How can we be able to get the cash inflows and the cash outflows? Step number one, which you need to know when you calculate the NPV, it is very important to know you have to be getting the initial outlay, right? That is my initial outlay. That is my initial outlay. So how do we normally get our initial outlay? We'll be able to say, to get your initial outlay, things will get better as we move on. So let us have two columns here of Kenya shillings. For example, we're going to Kenya shillings there. And we are going to be starting with the cost of machine. What is the cost of the machine or project? It might be a project or a machine. So this cost of the machine, you normally put it here. Sometimes we might be replacing a certain machine. Then we normally add things we are calling incidental costs. So the incidental cost, we have what? We have things like freight charges, right? Freight charges unaeka hapo. We have things like commissioning costs. You have things like commissioning costs. We put them there. We have things like installation costs. What is our installation cost? We put it there. Then we have things like import duty, among others. Let me just give an example of those. Import duty, you put them here. So the total you normally put at the end. What are we getting down here? We are getting something called the new cost. The new cost of the project or the machine. So we put it there. Sometimes you will be able to realize that the examiner telling you one of these critical things here. The examiner will be telling you, right, we might be purchasing a new machine and coming to replace an existing machine. So what do we normally do when we are getting the total cost? This should be the total cost. It should be the total cost of the machine. So in this case, if there is an existing machine and you want to dispose, so we have the information for disposal. Here is where we are going to be lessing. So here we less the disposal value of the old machine. The disposal value of the old machine with that there. Then you have also to be calculating something called tax on gain, stock loss on disposal. How do we normally get all this? We'll be able to say, to get the tax on gain, stock loss on disposal, first you have to be taking the disposal value of old machine. The disposal of the old machine, you put it there. Then we let the net book value. I know Mr. Ochoa is doing enough, less the net book value. Mr. Ochoa is able to teach you about the net book values of old machine. The net book value of the old machine. We know very well that together, the net book value, you normally take the costs, minus the depreciation, right? You get the net book value. So we put it here. And that is why we have said you deduct it. What you're going to be getting under the difference between the disposal value of the old machine and the net book value is normally called, you might be getting the tax gain. It might be a tax gain, stock loss on disposal. Now, ujue vizuri kuna kitu hapa inaitwa tax. So already what you are going to be getting here, it should be a gain, stock loss on disposal. But a tax lazima uweke tax rates. Correct? So in this case, this is what you are getting there. Then you multiply with the tax rate. You put the answer here. If it is positive, you add. If it is negative, you subtract. If it is negative, you subtract. So what are you going to be getting here? Here is where we normally get the new cost of the machine. So the new cost of the machine unapata hapo. Amounted to how much? Amounted to that figure, right? Then from there, we normally add something we normally call investments in working capital. We know very well when we are looking on the working capital, and we know Mr. Chue has worked a lot on these. You normally take the current assets minus current liability, right? The working capital, you put it there. So what you are going to be getting down there is normally called initially. But I have said very well, if this part is not applicable in a question, right? Applicable is always applicable during the disposal period. If you are not disposing a machine, sorry. I see we have a challenge there. Sorry for that. Let me get back a bit. Okay. Just 1 minute. Get things better. Okay. Sorry for that. So can you be able to see it? So everything I know is very clear. You can now be able to see. This is what I was discussing here. This is always applicable when we are disposing of a machine. If it is not applicable, you cannot be able to put it. We'll cram all these things. If, for example, in a question you find we are not disposing a machine, then this part becomes irrelevant. It becomes irrelevant, right? But now, after you get the total cost of the new machine, you are supposed now kuruka hii part yote, you come and add the investment in the working capital. The investment in the working capital. That is what you're going to be getting here. Now, step number 2, in the computation of the NPV, step number 2, we are supposed to be computing something called, what do we call it? We call the annual net cash flows. The annual net cash flows, we are going just to be having a column of Kenya shillings there, right? And then, remember there is a concept for the annuities. So if I have annuity, I'm not supposed to be, for example, the annuity nimesema, the generation of the cash flows zinafanana throughout. So, for example, if my project useful life is 5 years, I will just come here and say 1 to 5 years. In case of annuity, this is in case of annuity. Unaandika namna hii. You're not supposed to be doing for 1, 2, 3 years. But kama ningekuwa na lump sum, for example, year 1, 100,000, year 2, 150, namna hiyo. You normally write here every year, for example, if the project is for 5 years. If the project is for 5 years. Now, if, for example, we are dealing with the, with the annuity, what am I supposed to do? It's very simple. In that case, you normally come here and you tell me, Mwalimu, can I be able to take our sales? I say, let me take my sales. So how much is my sales? I put them here. Then we less variable costs. And I ask you, how much is my variable costs? You put them there, you get your contribution. Right? So the contribution, I put them there. Then from there, we look on the, we less our fixed costs. You less your fixed costs there. What are you getting down there? You're getting something called earnings before depreciation and taxes. You put them there. Mimi nataka kukuonyesha the simplest parts ya kupita hii kitu. Ukishapata earning before depreciation tax, let us less our tax at the rate of 30%, for instance, kama tumepewa 30, so unaiweka hapo. Then you add something called depreciation tax shield. Right? It is normally called DTS, depreciation tax shield. So how do we normally get our depreciation tax shield? You normally take the cost of the machine minus scrap, you divide by the number of years. The number of years. All of these, you multiply by tax rate. Let me just write here tax rate. You multiply by tax rate there. That is how you normally get the depreciation tax sheet. You take the cost minus the scrap, you divide by the number of years. You put it here, and then you are going to be adding. At the end of the day, what I'm going to be getting, it is normally called the annual net cash flows. This is the shortest form of getting the annual net cash flows. Then step number 3 and the last one. Step number 3. We normally compute another step number 3. We normally do terminal cash flows. You have invested on a certain project, and at the end of the period, you want to terminate it. You want to terminate. Ama, at a certain stage, you say, can I be able to terminate? Because due to the advance of the technology, you may know there is a better machine. I can be able to dispose the one that I have. So what do I normally do here? We say, let us take the scrap value of the new machine. The scrap value of the new machine, you put it there. Then we less the scrap value of old machine, the scrap value of the old machine. Then we normally add investments in working capital. Investment in working capital, we put them here. So at the end of the day, you'll be able to get your terminal cash flow here. You'll be able to get your terminal cash flow in that nature. That is how you normally get it. That is how you normally get it. Any question now? Any question? Any question so far? Any question? Someone to tell us something. Any question? Mtu anaweza sema sioni blackboard. Hello?
Yes, hello. Mwalimu, acha kwanza tumalize kuandika. I'm saying acha mwanzo tumalize kuandika.
Okay. Kuna swali walituletea pale because we just want to get back to basics. There is a question they brought for this on November 2017 question 1B. November 2017 question 1B. November 2017. Who is reading for us today? We are starting with Jackie. Sijui kama leo tutampata Jackie.
Iko.
Oh, good. You're being challenged by network, so sijui leo uko sawa. So let's go on. Good to see you in large numbers. So question number 1B here, right? It is here. A very simple question. Go on.
Question number 1B. Viwanda Limited is considering purchasing a machine at a cost of 40 million. The company will incur an additional 20 million to modify the machine for special use. The machine is expected to have a useful life of 3 years and a scrap value of 15 million after 3 years. This investment will require an increase in net working capital of 2 million at the beginning of its useful life. The additional investment in working capital will return to normal at the end of the machine useful life. The machine purchase will not affect revenue, but it is expected to save the company 25 million each year in before tax operating cost, mainly labor. The corporation tax rate is 30% and the company's cost of capital is 10%. Required. Advise Viwanda Limited on whether to buy the machine.
Thank you so much. That is the only question. And you can see the examiner, don't factor number 2. Hatujafika hapo. Tukishafika hapo, we shall come back. So in this case, when you look on the question on how it is framed, you'll be able to find, hakuna mahali examiner has told you to calculate the NPV now. The examiner has already told you to advise Viwanda Limited on whether to buy the machine. So it is very important for us to calculate what? We just need to calculate the NPV. So how do we normally calculate our NPV when we are given this information? I just want you to open this question from your ends. For those who don't have, mwanafunzi moja, for example, Nora, will be able to help the other students by sharing the link for the questions so that they can be able to follow from their ends. You can reshare that link. So in this case, let me just provide the solution of this question, which is very simple. And this is how you do it. So when you are doing this question here, you'll just do this. Just do this. We are doing November. Let's say November 2017. Question number 1. Very simple question. So ukiangalia swali hadi na mambo mingi. What am I supposed to be doing as a student? I will be able to say number 1. I need to calculate my initial rate. So let me calculate my initial rate. So I'm going just to be having the columns of Kenya shillings here. And you can decide to reduce your shillings to thousands. Nobody will be able to penalize you for that. Now, when you look on the question as provided here by the examiner, you will realize that the examiner has already given you the cost of the new machine. The examiner has given you the cost of new machine. The cost of the new machine, the examiner has told us, is 40,000. Hii hata ina maana. Haina maana because hatuna incidental cost. So 40 million. 40,000 in our case here. So the company will be able to incur additional cost of 20 million for modification. I just be able to tell you, add modification cost. So how much is our modification cost? We say the modification cost we are being told by the examiner is 60,000. Right? Is this 60 more? 20,000. Nimekimbia sana. So what is the total cost of the new machine? What is the total cost of the new machine? We'll be able to find the total cost of the new machine sums to 60,000. Hatuna anything regarding the disposal. So if it is not in the existence, hakuna haja ushinde ukiandika your format hapa, you ignore it. Then, when I continue reading my question under paragraph 3, we are being told, this investment will require an increase in the net working capital of 2 million at the beginning of this useful life. So here we are going to add investment in working capital. Now, examiner amekucalculatea kuambiwa totals to 2,000. What is the total for your initial day? I say, to get my initial day, I get 62,000. Other calculators need charge. You see, even I don't need a calculator in this case. Number 2, and the second stage, we say, can I be able to calculate the annual net cash flows? And what is it going to be guiding me to know? Am I dealing with the annuity or lump sum? It is based on the information provided. And when I can be able to see on additional information number, the second last, where we are being told, the machine purchase will not affect the revenues, but is expected to save the company 25 million each year before tax operating costs, mainly labor. I will just be able here to say, the project here to iko na miaka tatu. There are 3 years. So just say 1 to 3 years. Why am I taking the annuity concept? It's because every year we are going to be saving 25 million. And when you normally go to the market to purchase any product, right? Now you had a budget of 2,000, ukainunua 1,500. Unafurahianga sana hata unapitia mahali unakunywa chai. Because you have already realized some income. You got the product that you needed, and then at the end of the day, umefanya nini? Save 500. That is an income to you. So in this case, the company, once it saves 25 million, that becomes an income to the organization. If it is not a cost, it's an income. Very good. So we say our earning before depreciation and taxes becomes 25,000. Our earning before depreciation and taxes becomes 25,000. So in this case, we ask ourselves, what is the simplest way can I be able to get out of here? I tell you, can you be able to raise your tax at the rate of 30%? So 30% of 25,000, we are getting something closer to 7,500. That is a deduction. Then we normally add something called depreciation tax shield. So how do we normally calculate the depreciation tax shield? We said, let us take the total cost. You know, after we add this in Billy, the answer which you normally get here becomes the total cost of the machine. You know that very well. So in this case, what is the total cost of the machine? Is 60,000. So in this case, I say, let me take 60,000 minus, what is the scrap value of the new machine? There is an area where they have said, the machine is expected to have a useful life of 3 years and a scrap value of 15 million. In this case, can we talk about 15,000? Yes. Then we divide by the useful life of the project, which is 3 years. Which is 3 years. All of these, we multiply by 30% at the end. So what is our answer? Now you can take your calculator. So in this case, I say, once I take 60 minus 15, niliambiwa na mwalimu hesabu ni 45,000. I divide it by 3, getting 15,000. Then I multiply by 0.3, getting 4,500. So at the end of the day, I'm not struggling. What is our annual net cash flows? What is our annual net cash flows? We take 25,000 minus 7,500 plus my answer, which is 4,500. I will be able to get my annual net cash flows is 22,000. 22,000. Ukishamaliza hapo unafurahia sana. You go to step number 3 and you say, under the step number 3, can we be able to calculate the terminal cash flow? What is our terminal cash flow? And I will be able to say to calculate your terminal cash flow, chukua weke Kenya shillings hapo, right? Tell us, let us take the scrap value of the new machine. And you are being told the scrap value of the new machine is 15,000, equivalent to 15 million as per the question. This is to reduce our shillings to thousands. Then we less the scrap value of old machine. In our case here, we don't have. Then at the end of the day, we normally add investments in working capital. Investment in working capital, hata sihitaji hata past paper. The investment in working capital is 2,000. So what is my terminal cash flow? My TC will be equal to 17,000. Anyone with a question up to that point? Any question up to that point? Any question now? Any question to that point? Very good. So kama una swali, twende tuka discount these cash flow to the present values. We'll be able to say, let us pick our years here. So we have our years, we have our cash flows. Then we have the discount factor. As per the question, we are given a discount factor as per the what? The discount factor tumepewa pale, the cost of capital, tumepewa amounting to how much? Let me check from the question. So pale chini tumeambiwa, and the cost of capital is 10%. Then you determine what is your present value. This is very simple. So in this case hapa nakuja nasema, year zangu za kwanza niko na 1 to 3 years. My cash flow nitakuwa kila mwaka napata 22,000. Then bado mwaka ikiisha, the project during the useful life of the project yenye inaisha the 3rd year, right? Nitapata terminal cash flow ya 17,000. Napata terminal cash flow ya 17,000, right? So how am I going to be getting this? The discount factors. Tunasema vizuri, you have to be understanding the concept of the annuities and lump sums. So ikikaa namna hii, hiyo unaniambia ni annuity. Ikikaa namna hii, unaniambia ni lump sum. Pesa unapata once na utaipata tena, ni kama za tenda. So in this case, what is the formula for the annuities? Nakwambia unachukuanga 1 minus 1 plus r you raise to power negative n divided by r. This is the formula for the annuity. And also you can be able to use the tables. For the lump sum, you normally take 1 plus r, you raise to power negative n. 1 plus r, you raise to power negative n. Our r is our discount factor. Our n is the number of years. So in our case here, we are discussing about 3 years. So what am I supposed to be doing? I say, can I be able to take 1 plus 0.1, which is coming from 10 divided by 100, get it 0.1, right? We'll get 1.1. Then you raise to negative 3. Our n is 3 years, right? Negative 3. You get your answer. For example, hii ningeandika hapa ni 0.7513. 0.7513. But what about the first one? Now I will be able to take 1 minus my answer. 1 minus your answer. Then you divide it by your rate, which is 0.1. Getting something closer to 2.4869. What is my present values? The present values where you normally take your cash flows, you multiply by the discount factors, you get the present values. You get the present values. So in this case, let us do that. Wacha tufanye hiyo kazi saa hii. So when I'm taking my 22,000, when I'm taking 22,000 here, I just multiply it with 2.4869, getting 54,712. Then what about the last one? We say 17,000 times 0.7513. We are getting 12. I'm just ignoring the decimals. 772. The answer that you normally get here, it is normally called the present value of the cash inflows. What is the present value of the cash inflows? Just take the summation of the two. So 12,772 plus 54,712. Getting something closer to 67,484. So to determine what the examiner is asking, can you be able to deduct your initial outlay? So to get your initial outlay, which is 62,000. What is the difference? So the difference will be 5484. This is our NPV. 5484, and that is your NPV. That is your NPV, 5484. So after you get your NPV now, you can see ours is positive. Under the acceptance criteria, because the examiner is asking you to advise. So what am I going to be advising here? You say, you can be able to tell them this. Viwanda Limited should buy the machine. Why am I saying so? Viwanda Limited should buy the machine. The Viwanda Limited should be able to buy the machine because, or since the NPV is positive. Since the NPV is positive. Since the NPV is positive. But if we could have gotten the negative here, right? We could tell them they are not supposed to be buying that machine since the NPV is negative, if that was the case. Any question at that point? Any question? Any question? Any question? Say something. Are we okay? Hello? Alert Koengi, we are not supposed to be quiet. We're not supposed to be quiet. We're not supposed. We're not supposed to be quiet. They just want to do the very important things. So, because we are quiet, it means we are okay. Now, from here, I just want to look on the internal rate of return. Thereafter, you'll be able to check on the the internal rate of return, profitability index. The others will be able to follow us as we move on. For example, the payback periods. Can I be able to show you how the payback period for the, does it normally work from this illustration? I can be able to show you. Because, for instance, if you were to calculate the payback period using the question provided here, let me just grab it. Because I explained to you about the payback period before I go to the internal rate of return. Now, we remember very well that when we were discussing about a payback period, right? A payback period, we said it is just a duration taken by the project to generate sufficient cash flows required to recover the initial outlay, right? It is a period taken by a project, right? Period taken by the project to generate the required initial outlay. And we said, under the payback period, we said we can be able to deal with regular cash flows. We said, when you're having the regular cash flows, just use a formula to get the payback periods. We are going to be using our initial outlay. We are going to be using the initial outlay. We divide by annual net cash flows. But what about when we have irregular cash flows? When we are dealing with the irregular cash flows, we have said, just cumulate the cash flows. Accumulate the cash flows until the initial outlay is attained. Let us look on whether we are using the regular cash flows, right? Using the illustration given here. So when you're using these illustrations and you want to get this question for payback period, we just say, because you can see there are some regular cash flows here, which you are generating each and every time. How can I be able to calculate the payback period? I say, if you want to get the payback period of the question, you take the initial outlay. Our initial outlay is 62,000. You divide it with what? We divide it with annual net cash flows, which is 22,000. So how much is this? 62,000 divided by 22,000. You're supposed to be getting the payback period. How much is this? 62,000 divided by 22,000. We are getting 2.82 years. That is the period tutachukua to recover our initial claim of 62 million. But what about if it was irregular cash flow? This is what you normally do. You take your years here. You take your cash flows. Then we accumulate our cash flows. Can we be able to accumulate the cash flows? Very good. So when you look at these projects of ours, year one, we generate 22,000. So we accumulate to inakuwa 22,000. Year two, tuna generate bado 22,000. So this translates to 44,000. Year three, we are generating still 22,000. But what do we need? Unakuja hapo unaniambia, I don't need the 22,000 we are generating, but we are almost getting our 62,000. The question is, how much is the cash flow required to attain 62,000? I just look for the difference between 44 and 62. So 62 minus 44, unapata, unahitaji tu cash flow ya 18,000 to attain your initial claim. So inamaanisha, I have used, to get your payback period, umetumia 2 years fully, plus some months for year 3. So hizi months utazipata aje. Nakwambia chukua ile cash flow required to attain your initial claim, which is 18,000. You divide by the cash flow generated for the full year of year 3, which we are generating 22,000. 22,000. So ukichukua 18,000 divided by 22,000, right? Plus 2, we are getting also 2.82 years. 2.2 years. 2.82 years. 2.82 years. That is how you normally calculate the issues of payback periods, whether you are using the regular cash flows or irregular cash flows, right? Irregular cash flows. That is how you normally do. That is what you normally do. But what about when we have the issues of internal rate of return? I just want us to understand what is this internal rate of return. Let me just run here. Am I too fast? Am I too fast? Dan, am I too fast? Okay, there are people who have greeted me here. That's
No, you're okay.
Okay. No, sisi tushamaliza. Sisi tushamalizia hapa. Sisi tunaendelea tuna syllabus yetu. Sisi tunaendelea. Payback period na kufunza is just a syllabus. Swali iliishia hapa. Right? So, hiyo swali iliishia hapo mahali tulipata. Sisi tunaendelea tuna syllabus. Nimekufunza venye unaweza pata payback period. We are just using that illustration. It doesn't mean that ati hizo vitu zote umeulizwa hapana. Hapana, haja kuuliza payback period kwa hiyo swali. Now, can we use the same illustration to know how can we be able to calculate the internal rate of return? And this is the thing that you learned there before. But before I show you how to calculate the internal rate of return, I just want to take you back to our notes. And I'll be able to say, when you are calculating the internal rate of return here, we are saying it is the discount factor at which the NPV is equal to 0. So in this case, it means if it is a discount, it is the IRR normally represents, or it is used as a break-even of the NPV. And that is why we are saying the first step when you are calculating the internal rate of return, you have first to get the NPV. Then we are saying if the NPV is positive, it means that the cost of capital is lower than the internal rate of return, right? If the cost of capital is lower than the internal rate of return, we normally increase the cost of capital using the trial and error experiments method, and we calculate the NPV aiming to generate the negative or 0 NPV. So the opposite normally applies, but allow me just to, I don't know what I'm sharing now. Okay, I've shared my notes. So in simple terms, so vitu mingi na kueleza hapo ni mingi sana. So how do we normally calculate the NPV? I just want to write the formula here first. You normally take the lower rates plus. Here we normally talk about the differences in, We normally take the NPV of lower rates. We divide it by differences in NPVs, right? Then here we multiply by, I don't know whether you're seeing here, we multiply by higher rate minus lower rates. Higher rate minus lower rates. Correct, it should be looking like that now. So in this case, when you're looking on our question here, we got a positive NPV with 10%. Ni sawa. Now because tumeambiwa when you are calculating the error, unatumianga the trial and error experiments, tunataka tupate another NPV yenye iko negative. Sawa. So hapa ndio kila mtu anatumia rate yake. Ukipata 10 na hapa ni positive, it means you go higher, aiming for a negative NPV. For example, if tungepata 10, this 10% which is our discount factor, hapa tupate negative, tungeenda chini. Tungerudi huku kama 4%. Tungerudi kama 4%. So how do I normally do this? In a very simple way, I'll just be able to say, because nimepata 10 nikapata positive, can I be able to try around 28%? I say, yes we can. Na hapa kila mtu anapaswa kupata answer yake. So what is our cash flows? Our cash flow tuko nazo hapa ni 22,000. Discount factor, tumesema tumetumia trial and error, sisi tunatumia 24% ama 28. Ukitumia tu yote. Get your present values there. get your present values. I know you cannot be able to see here, but this is 22,000. Then year 3 again, we are getting 17,000. Wacha tuone kama tutapata negative NPV. Now in this case, let us now embrace our formulas. Tulisema hii tunatumia formula inaitwa 1 minus 1 plus r raised to power negative n divided by r. So we are just taking 1 plus 0.24, getting 1.24. We raise to power negative 3, right? Let me start solving these ones. I say 0.5245, right? Then the upper end it will be 1 minus my answer divided by 0.24. Here we are getting 1.9813. Take 22,000 times 1.9813. We are getting 43,589. Then we have 17,000 here times 0.5245. We are getting 8917. What are we getting down here? We are getting the present value of the cash inflow. What is the summation? Plus 43,589, getting 52,506, something closer to that. Then you less your initial thing. Now ukiangalia vizuri sisi tumepata a negative NPV. That is what we were aiming. So what is our negative NPV here? You take 52,501 or 506 minus 62,000. You're getting 94.95. That one is negative. That one is negative. Ushamaliza to get that one. Ushamaliza to get that one. Nakuja hapo naniambia, mwalimu, because you have already gotten the NPV, so let us apply the formula to get IRR. And we say to get our IRR, the lower rate of ours is 10. So you put here 10 plus. What is the NPV of the lower rate? Ulipata 54.84. You divide it by, what is the difference of the NPVs? Unachukua 54.84 minus 94.95. Then here we look on the difference between the higher rate, which is 24, minus 10. So here answer yetu ni ngapi? 54.84 plus 94.95. Hapa chini kwanza we are getting how much? Here we are getting 14,979. So 54.84 divided by answer, you are getting 0.36. All of this, 0.36. Then we multiply by 14 first. Right? Then you add 10. Yeah. My answer should be 15.13%. That is your IRR. That is your internal rate of return. And you have said very well, if the IRR is greater than the cost of capital, if the IRR is greater than the cost of capital, correct? We are saying the project is good and vice versa. The project equals sour, project equals sour, project equals sour. That is how you normally calculate the internal rate of return, the internal rate of return. Any questions? Any question? Any question? Okay, no, we don't have any question now. So what are we supposed to be doing here? We are supposed now to be giving out an assignment, which I think should be done and shared in our WhatsApp group. A question tested on September 2015, question 4 is our assignments. Our assignments, we look on September. Ulifanyia tu part 1, question 4. Sinyumize kichwa. September 2015, question 4. September 2015, question 4. Just do the part for the NPV. You can use the same question to repeat the concept for the internal rate of return and the payback period. You can just use it to do all that. Once you finish doing that, it is very crucial for us to check some few things here. Let me see whether we have those notes here with us. Then you hizo answers, not answers, but the notes, whether tuko nazo. Allow me. It is not here. Let me check another documents. Another document. Are we understanding? Are we understanding? Hello.
Yes, we understand.
Hawa watu wote najiongelesha. Waone kwanza.
We
Yes,
understand.
mwalimu tumeelewa.
Oh, good. Okay. I just want to look on a very simple concept here, which we should be closing our nights. It is not part of the notes. There is a part which I just want, it is a subtopic now. We are engaging now on very many subtopics. This one is normally called the investment decisions under risk and uncertainty.
Excuse me, sir.
Yes, yes.
Will you mind sharing the notes that you had for the capital budgeting as from the introduction to where you have reached?
Communicating right now.
I'm requesting if you'll mind sharing with us the notes
What is your name,
for
please?
investment.
Your name, please.
Ati nini?
Jina naongea na nani?
Sir, I'm not I'm not getting you when you're replying, so I don't know whether you have get it or not.
I'm asking Gina. Who am I speaking to?
The note that you have just used to
No problem. Who am I speaking to?
What's your name?
Hello?
Yes.
Hauna jina.
Mwalimu, uni mjalo elewi Kiswahili. Ongelesha hii Kizungu.
Hana jina.
Muongelesha na Kizungu. Mjalo elewi Kiswahili.
Who am I speaking with? Ni Lillian. It is Lillian, right?
Yes, yes.
So, it means that you have not been following our chat in our WhatsApp. These things I highlighted. And I say, can you be able to read this? Can you be able to read this? Because of those things I have already shared, we can share again. Because so many.
Well, you have shared, but the reason why I'm requesting if you can reshare, the one that I've gone through, they're totally different from what you are using.
Okay.
Unless I'm the one who is not keen with my notes, but that is what I have realized.
So, I will just share them again. So sometimes when you are doing investment decisions, there are a lot of things which are basically involved. And those things we discuss and we normally discuss of the risk and uncertainties involved. Those two things are always involved in our decisions which we want to undertake. And in that case, we are saying, when you are measuring this risk involved in a certain project, we normally use standard deviations, right? Or we normally use the standard deviation or coefficient of variation. And in this case, we say, let me just put it clear here. We say risk is measured. Risk is measured using standard deviation. Risk is basically measured using the standard deviation. And it refers to the variability. Normally refer to the variability Remember, it refers to the variability of expected returns. Of expected returns with the actual returns of the project. With the actual returns of the project. With the expected returns of the project. And we say it is similar to uncertainty, except that the risk has some, it is normally associated with probabilities, while uncertainties have no probabilities attached. So in this case, the point which I can be able to say here, the higher the standard deviation, if we are comparing different projects, the higher the standard deviation, here, we say, the higher the risk. The higher the risk, right? The higher the risk. So in this case, it is very important to understand that we had some formulas on the computation of the standard deviation. For example, we remember there before we used to say, to get the standard deviation, we used to take the summation of x minus x bar squared, then we used to multiply with the probabilities. But here now we are not going to be using x and x bar. Here we are discussing about a very simple concepts. Na hii kitu umeiona pale kwa portfolio. We are going to be now taking the returns minus the expected return. Returns minus expected returns. We multiply by, we square them and then we multiply by probabilities. And you remember we talked about the concept of in case of the sample size is what normally applies in those concepts. In case it is less than, we divide by n minus 1. If it is greater than 30, you divide by n. But we know very well that this standard deviation is basically used to measure the magnitude of the variance. So basically you can be able to use the coefficient of variation. And when you are using the coefficient of variation, which I have said, also it is basically used to measure the risk. It is normally written like this. We normally take the standard deviation, you divide it by the expected return. Then you multiply it with 100%. This is the formula to use when you are calculating those, two. But to be very quick, allow me just to introduce to you to a question here tested already. May 2019. Tumeanza syllabus sasa. May 2019 question 5A. Tumeanza marathon kidogo for this topic. So May 2019 question 5A, how can we be able to understand on how we normally do this? Let us go there. Naona tu watu wengi hapa hawajaongea leo. Watu wengi hawajaongea leo. But some will be able to read for us. So 2019 here, we have question 5A.
Mwalimu, this is November, not May.
Oh, sorry. Okay, thank you. Oh, good. Someone read for us. Someone, please. Someone. Soma, Lilian?
The question, Zara Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 each. Installation cost for all the computers will amount to 80,000. It is estimated that once installed, the computer will increase the company's earnings before depreciation and tax from 12 million to 12,500,000 annually. The computers are expected to last for 10 years, after which they will be obsolete with no resale value. The operation manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computer for only 5 years. After which they can be disposed of at 50,000 each. The probability of the useful life of the computers is given as follows. Probability of 0.20, useful life of 5 years. Probability of 0.5 at 10 years, then probability of 0.3 at 15 years. The company is in the 30% tax bracket. The company's cost of capital is 24% and uses the straight line method of depreciation. Required, the expected net present value of the project at 4 marks. Standard deviations of the expected net present value at 3 marks. If
Thank you so much. You can see how the question is. Sorry? Oh, I don't even know. I'm sure we are being told if the net present value of the project is less than 200,000, the firm will be exposed to a financial distress. Determine the probability that the firm will avoid financial distress, and then we are going to be assuming a normal distribution. Kama ulikuwa mbaya pale kwa statistics, taumia sana huko. Now, in this case, we are just being given a very simple question, and the examiner is asking us to get the expected NPV of the project, and we are given 4 marks. So in this case, to get the expected NPV, this is what you have to do. So nakuja tu hapo naambia examiner, right? Let me first write the year of the question. We are doing May 2019. We are doing question number what? The question number 5A. Tunaambia examiner si tushasoma portfolio, we understand hizi criteria. Tunamwambia ukishasema expected tunajua kuna probability. So kama unataka expected NPV, tunakwambia vizuri, wacha sisi tuchukue the summation of NPV, then we multiply with the probabilities of ours. Hata kama probability hakuna, sisi tutatumia sample size. So we know. So what we can be able to do here, we follow the steps of computation of the NPV. Number 1, we do the initial lead, and we say to get our initial lead, very simple. Very simple. How is it simple? Let us look on these computers they are talking about. So what will be the cost of the total number of the computers which we want to install here, right? So how many computers do we want to install? It will be very
8.
We say the computer that we want to install, they are 8, and each computer is costing us 100,000. So what is the total cost of these computers? So what is the total cost? So we are getting 800, right? 800,000. Then we are being also told in the same statement that the computer is installation cost for all the computers will amount to 80,000. So hapo unakuja unaniambia, can we be able to add installments? Installation cost of 80. So what is your initial? Hata ina mambo mengi. 880. Then ushamaliza kufanya hivi, kuna majamaa wengine wamekuja pale with different opinions. Mmoja anasema hizi kompyuta zitakaa miaka 5. Unamwambia wacha wewe nikufanyie analysis yako when I'm calculating your annual net cash flows. Kuna majamaa pale wamekuja wako na mastori zao. Kila mtu anaongea vitu zake. So kila mtu mpe analysis yake. Wa 1 to 5 years na mpe analysis yake hapo. 1 to 10 mpe analysis zake peke yake. Kuna mwingine anasema 1 to 15 years. Wacha kae na analysis zake hapo. The 1 to 15 years. But on the same scenario, we are being told very simple that the computers will increase the company's earning before depreciation and taxes from 12 million. So what is the increase in earning before depreciation and taxes? It means you're going to be taking 12,500 minus 12,000. 12.5 million minus 12 million, the difference will be the increase in earning before depreciation and taxes. And it will be 500. 500 there. Correct? Then we less our taxes. We less our tax at the rate of 30%. So this translates 30% of that inakuwa ngapi? Is it 150? 150. Then here we have 150 there, right? Then what we are supposed now to be looking here and being very keen is when you are calculating our depreciation tax sheet. Unaangalia jamaa wa 5 years, yeye anasema aje? Umeambiwa vizuri tuanze huko chini because your statement inaanzia pande ya chini pale. Tumeambiwa one of the guys anasema hivi. Anasema nini? The marketing manager on the other hand argues that the company needs the computers for only 5 years, after which they can be disposed at 50,000 each. So in this case, it is very simple. What is the total cost of the machine? Unakuja uniambia hapa ni venye hatuna vitu mingi, but the cost of the machine should be the cost plus the installation. So in this case, we are discussing about 880 minus the scrap value of each machine will be 50. So 50 times 8.
50.
Right? Then we divide by the number of years. Hapa tumeambiwa ni 5 years. For the first 5 years, then we multiply by the tax rate, which is 30%. Huyo ni wa kwanza. Huyo ni mtu wa kwanza. Yeye ametoa hiyo ndio maoni yake. So 880 minus 400 divide by 5 years times 0.3, we are getting 28.8. Tuangalie mtu wa 1 to 10 years. Yeye anasema nini? Mtu wa 1 to 10 years, yeye anapiga story zake pale. The 1 to 10 years anatuambia vizuri. The computers are expected to last for 10 years, after which they will be obsolete with no resale value. So hapo la kuyo niambia, it will be 880 minus 0 divided by 5 years. Sorry, 10 years. Right? Then you multiply by 30%. So hapo la kuyo niambia very simple, 880. So that is translated to 88 times 0.3. We are getting 26.4. So it is very simple. Itakaa namna hii. This will be 26.4 upon a dash. Then tuende huyu jamaa mwingine wa 15 years. Yeye anasema nini? Jamaa wa 15 years anatuambia vizuri. The operation manager proposes that the computers will be useful for 15 years with no resale value. Cost yake ni 880 minus 0 divided by 15 years. Then you multiply by 30%. Multiply by 30%. 880 divided by 15 times 0.3, getting 17.6. Oh, sorry, 17.6. So what is your annual net cash flows? What is our annual net cash flows? So let me start with the first one. 500 minus 150 plus 28.8 Get it 378.8. The other one will be 500 minus 150 plus 26.4. Get it 376.4. The last one will be 500 minus 150 plus 17.6. Get it 367.6. 367.6. Kishamalizana na calculate your annual net cash flows. Twende pale calculate number 3. Tulimuita nani? Terminal cash flows. Na cash flows za terminals zinatokanga mahali kuna scrap value. So tuko tuna scrap value wa 1 to 5 years, which is very simple. Unakuja hapo unaniambia, let us take the scrap value of new machine. The scrap ya new machines ni uliniambia ni 400. This one. So unakuja tu unaniwekea hapa. Hatuna scrap value mwingine. Hatuna scrap value mwingine. Ushamalizana na yeye namna hii. Kuja hapo calculate your NPV. Inda kucalculate tofauti. Kuja hapo niambie now, let's start with 1 to 5 years. Calculate your NPV. Na ukiangalia NPV ya 1 to 5 years ni annuity. So, kuna kitu inakaanga namna hii. Nakuja hapo unaniambia, let us take 378.8 times the present value interest factor annuity. PFIFA, right? PFIFA. What is our discount factor? I think it should be 10%. Oh, 24%. 24%, 5 years. Right? Plus, that is PFIFA because this is annuity for the period of 5 years. But at the end of our project of year 5, you are going to be getting a scrap value of 400 times the present value interest factor, PFIF, aina A, because this will be experienced only once. So 24%, 5 years, then you minus your initial outlay of 880. Hapo utapata 21 to 10 years. 1 to 10 years. Na hizo hazina scrap value. These are in a terminal cash flow. They are very simple. So to calculate 1 to 10 years, the NPV will be looking like this, right? It will be very simple. We take the cash flow, 376.4, times the present value interest factor annuity, 24%, 10 years, minus aina terminal cash flow. So in a direct 2, minus 880. Then the last one, 1 to 15 years. Unakuja hapo ananiambia to calculate my NPV will be equal to 367.6 times the present value interest factor annuity, 24%, 15 years, minus the initial outlay of 880. So how much are we getting there? Very simple. So once we start, remember the formula to get this, we said it is 1 minus 1 plus R raised to negative n divided by R. The formula ya hii tulisema ni 1 plus R we raised to negative n. So can we be able to get our answers? Very simple. So it will be 378.4, but I need first to get this one. So it is 1.24. I raised for negative 5. 1 minus answer. Then you divide by 0.24. What you are getting here is 2.7454. Na hii ni ngapi? So it is very simple. 1.24 raised for negative 5. Get it 0.3411. Wewe chukua tu multiply now. Direct. So unachukua 378.8 times 2.7454 plus 400 times 0.3411 minus 880. I'm getting 296 here. 296.40. 296.40 there. The other one will be this one now. So you know this. So you know the formula. So it will be just 1.24. I raised for negative 10. 1 minus answer divided by 0.24. Here we are getting 3.64. Itaonyesha hata kutumia table. 3.68 19. So 376.4 times my answer here, minus 880. You're supposed to be getting something closer to 505.85. Then the last one will be in ngapi. Very simple. 1.24 we raised to power negative 15. 1 minus answer. Then we divide by 0.24. Just using my formula. So this one you are going to be getting 4.0013. So 367.6 times my answer minus 880. Getting 590.88. So to get the requirement of the examiner wanted us to get the expected NPV. So nachukua, for example, the first one is 296.40. You multiply by the probability as provided in the question. So what is the probability? The probability distribution provided for 5 years, 0.20 plus, the other one will be how much? For 10 years. So I take 505.85 times 0.50 plus, the other one we are discussing about 590.88 times 0.30. So how much it is? 296.40 times 0.20 plus 505.85 times 0.50 plus 590.88 times 0.30. The expected of years will be around 489. 489.47. 489.47. Nani ako na swali mpaka hapo? Any question, Catherine? Any
No question.
Sorry?
No question.
Okay. Number 2, examiner was asking you to calculate the standard deviation. And we said, to get the standard deviation is very simple. We take the summation of the return minus the expected return squared, multiply by a probability. So in this case, remember now we are using something called NPV. So unakuja hapo unaniambia mwalimu, tunachukua NPV minus the expected NPV squared, multiply by the probability. So what is our NPVs? The first one will be very simple, 296.4 minus the expected NPV, 489.47. This one we take squared, we multiply by 0.20. The other one will be how much? 505.85 minus 489.47 squared times the probability, 0.50. Then the third one will be how much? 489.47. No. The other one will be 590.88 minus 489.47 squared multiplied by the probability of 0.30. So how much it is? How much are you getting here? So hapo unapata vitu rahisi. So tunaanza na ya kwanza, 296.40 minus 489.47 squared. Then we multiply by 0.20, getting 74.55. 74.55.20. The other one will be 505.85 minus 489.47 squared. Then I multiply it with 0.50, getting 134. 134.15. Then the last one will be 590.88 minus 489.47 squared. Then we multiply by 0.3. You are getting 30.85.88 0.20. What is the total here? So your total plus 134.15 plus 7455.20. Getting a total of 10,674.55. So to get your standard deviation, you take the root of these variance you have gotten. So the root of 10,674.55. How much are we getting? The root of my answer, it should be 103.32. 103.32. Any question at that point? 103.32 is the solution of our question. Number 3, examiner is discussing about the application of the examiner is talking about the application of something called the normal distribution table. And when you are using the normal distribution table, I just wanted to remind ourselves that the normal distribution table or the normal distribution curves, we used to say the area under the curve is always equal to 1. So lazima tutumie kaugali ya nani? Ile ya Muluya sasa vizuri. Lazima tutumie vizuri. This is what we talk about. The normal distribution table. I remember very well, tulikuwa tunagawanyishanga aka kaugali ketu into half. Then hapa we used to put our mean. So in this case, we are putting our expected NPV, which is equal to 489 point something 47. So tunaambiwa that ukitumia number line hapa vizuri, unaambiwa the 200,000. Tukishuka tu chini ya hiyo 200,000, the company will be exposed into financial distress. So ukiangalia vizuri kwa hii number line yako, unapata 200 iko hapa, right? This is your NPV now, which is 200. And then examiner anakuambia vitu rahisi. Wewe tufanyie when the company will not be exposed to the financial distress. I'll be able to say, haiwezi kuwa huku itakuwa exposed, but hapa haitakuwa exposed. Itakuwa namna hiyo. So ikiwa namna hiyo, it's very simple because you know the area under the curve is equal to 1. So inamaanisha each side half is 0.5. But now we have to be calculating what is the proportion between here and here. What is the proportion? Now you'll be able to say we are using the z-score. You remember we used to say x minus u divided by the standard deviation. This now is not what we are using. This is natumia NPV minus the expected NPV. You divide it by standard deviation. You know that our standard deviation is equal to 103.32. So let us get it. So it will be 200 minus 489.47. You divide it by 103.32. What is the answer here? So 200 minus 489.47 divided by 103.32. You are getting something closer to 2.80. When are you utapata negative? Ukipata negative, always ignore your negative. Sawa, hakuna kwa normal distribution mahali kuna negative. Ukipata negative, you ignore it. Once you get that negative, just ignore it. So where are we going to be learning about the application of this? Unaenda kwa ile normal distribution curve. Na inakuanga imeprovidiwa by the examiner. So let us just check from one of the key papers. Key papers zenye zinatokanga hizi vitu ni moja ni gani? Wacha tuende kwa QA. Tuende kwa quantitative analysis. Tuone kama tutapata the normal distribution table. Tuone kama tutapata moja. So that I can teach you how to apply it. But in an exam, utatafuta kama mimi. Examiner atakupea. Examiner atakupea. So I'm just looking. Tuone kama tutapata moja normal distribution table. Okay. Maybe I can get to one. A normal distribution table. Okay. Then I channel shortcuts. Let me just search here. And come, I will get one. Okay. Okay. Just 1 minute. Like we can conclude. Natafuta kwa hizi paper tu za QA hapa because najua examiner atakupea ile yake. But sisi we have to be looking for one. So wacha tuone kama tutapata moja. Let's try something different, but we cannot get. Ndio kwa QA kama tutapata moja. Okay. Last semester wajaleta table. Tuangalie April. So April kwa QA walileta nini? Hapo pia kuna. No table there. Let me pause here. So ukiangalia hapa you just check on the 2.8. It should be 2.80 because you cannot go to 1. It's just 2.80. You can see the Z-score viewers, you have gotten 2.8. Then you go to the 0 column. So when you look at it, we have 0.4974. 0.4974. 0.4974. Ushaangalia namna hiyo, unakuja hapo unaniambia sasa this table of ours yenye tumechora pale 0.4974 inalai wapi? Unaniambia ni hapa 0.4974. So ndio tujibu swali yetu, nakuja waniambia we need to take a summation of 0.4974 plus 0.5. This one. Because hii tunataka kutoka hapa mpaka huko. So this translates to 0.9974. 0.9974. 0.9974. 0.9974. That is what will be required by the examiner. So next time when we are meeting, we are just going to be doing the investment decision under inflation. Then thereafter, we just check on the techniques of handling risk. The techniques of handling risk. Any question? Any question?